How much worse can housing in America really get? For years, people have been saying the same thing. Prices can't go any higher. Buyers are already stretched to the limit. But every new data point tells a different story. The median age of a first-time buyer is now approaching 40, the highest in modern history. The typical mortgage payment on the median home consumes almost 40% of the median household income. And in some cities, that burden climbs toward 90% numbers that don't just strain budgets, they break them. Yet even with all of this, a quiet assumption persists. We must be close to the limit. After all, how much worse can affordability realistically become? The uncomfortable truth is that the U.S. housing market is nowhere near its structural ceiling. In fact, many of the forces shaping today's prices rate lock-in regional imbalances, job concentration, underbuilding, and insurance volatility suggest that America may only be in the early stages of a much deeper housing affordability crisis. Median prices dipping slightly over the past few years have given some people false hope, but when fewer homes sell, the data stops reflecting reality. Prices don't fall because buyers can afford more. They fall because nobody can afford enough to keep the market moving. In this breakdown, we're going to peel back the layers and examine the U.S. housing market in 4 levels, starting with the surface-level problems everybody sees, and moving toward the structural forces that almost no one talks about. Stay with us, because by the end of this video, you'll see why the United States may be only in Level 1 of a much larger housing crisis. Level 1, the U.S. reality. Affordability is already broken. On the surface, the American housing market already looks like it's in crisis. When you hear that the typical home now costs roughly 5 times the median household income, it feels like a system stretched as far as it can go. A healthy market usually sits closer to 3 times income. Anything above 4 is considered severely unaffordable. So at first glance, America seems to have crossed that line long ago. But the deeper you look, the more you realize this isn't a peak. It's a starting point. Mortgage payments now consume close to 40% of the typical household's income. And that figure doesn't even include the expenses nobody can negotiate around insurance taxes, maintenance, utilities. In certain metros, total carrying costs push toward 90% of a household's take-home pay, which essentially means the average family can no longer afford the average home. And if that sounds unsustainable, that's because it is. Yet strangely, national home prices haven't fallen in any meaningful way. Yes, the median sales price dipped after its 2022 peak, and some people celebrated that as proof affordability was turning a corner. But that interpretation misses the bigger picture. The number of homes actually being sold is still down sharply, with transactions falling more than 25% compared to pre-pandemic levels. The median price doesn't represent the full market. It represents the thin slice of homes that are still changing hands. Lower-priced listings dominate during downturns, so the data appears softer than the reality experienced by would-be buyers. The core reason prices remain elevated is something the U.S. has never seen at this scale: rate lock-in. Millions of homeowners refinanced into sub-3% mortgages between 2020 and 2021. They are now effectively frozen in place. If they sell, they face a mortgage rate 2 or 3 times higher than what they currently pay. So even when people need to move, changing jobs, relocating, downsizing, they tend to hold on to their homes and rent them out while renting elsewhere themselves. This behavior removes a massive amount of supply from the market and creates an artificial floor under prices. The result is a shortage that isn't caused by construction alone, but by an unwillingness to release inventory. And because locked-in owners typically have strong financial positions, they don't panic sell. That eliminates the one mechanism that historically allowed home prices to reset: forced selling. Without distressed inventory, the U.S. market never fully corrects downward. It just stalls at a high level. We can already see the effects in cities where purchasing has become nearly impossible. New York, Miami, and San Jose now hover around multiples of 10 to 12 times local disposable income's a threshold that would classify them as severely unaffordable even by global standards. These aren't cities experiencing temporary bubbles. They're cities where structural demand, job concentration, and restricted supply collide. And the more these markets drift away from the national average, the more young buyers get priced out entirely, forced to delay homeownership until well into their 30s, or increasingly, to give up on it altogether. This affordability breakdown is also changing the shape of American households. More adult children are moving back in with parents. More couples are doubling up. More buyers are turning to 1% down mortgages, 40-year terms, and other last resort financing options that stretch payments across decades. These tools don't make homes cheaper. They just make the monthly pain easier to hide. If this is what level 1 looks like, it's clear the crisis isn't approaching a limit. It's building towards something else, something deeper, slower, and harder to reverse. Because beneath these surface-level symptoms lies a set of structural pressures that are already reshaping the American housing landscape. And that brings us to level 2, where the forces inside the U.S. start pushing prices upward, even when demand falls. Level 2. Internal U.S. pressures. Consolidation, migration, and broken supply. If level 1 shows that affordability is already broken, level 2 explains why the U.S. housing market keeps tightening, even when demand should logically be cooling. What's happening now isn't just a price problem. It's a structural shift in how America works, moves, and builds. These internal pressures are not temporary. They're reshaping where opportunity exists, who can access it, and how housing responds. The first major force is economic consolidation. For decades, jobs were spread across hundreds of counties, giving families options to live affordably without sacrificing career prospects. But that balance has quietly eroded. As of 2024, just 31 counties account for more than 1/3 of the entire nation's economic output. That means a country of more than 300 million people is increasingly dependent on a tiny handful of metro regions. When opportunity clusters, people follow, driving housing demand in these regions far faster than supply can expand. This creates an uneven America. Places with booming industries, tech in the Bay Area, finance in New York, biotech in Boston, corporate expansion in Austin or Nashville, absorb the majority of high-paying jobs, pushing local prices up. Meanwhile, regions that lose industries see declining demand, stagnant wages, and slower construction. The gap between economic magnet cities and everyone else grows wider each year. This polarization influences migration. During the pandemic, Americans relocated in record numbers. Many left expensive metros in search of more space, better affordability, or flexible remote work arrangements. Cities like Tampa, Salt Lake City, Phoenix, and Austin saw double-digit population inflows, which instantly pushed home prices up faster than local incomes. But once mortgage rates surged, mobility dropped. Homeowners locked into ultra-low rates stayed put, while renters found fewer attractive destinations than before. The result is a nation where movement slows, but price pressures persist. For decades, zoning offices across the U.S. have made it difficult to add housing at the pace needed to match population growth. Lengthy permitting timelines, local opposition, and labor shortages all play a role. Even when demand rises sharply, construction capacity is capped. And while some markets are trying to liberalize, zoning progress is inconsistent and too slow to offset the structural shortage. Institutional investors add another layer of pressure. Large-scale buyers ranging from private equity funds to real estate investment groups have been acquiring single-family homes, especially in entry-level segments. These homes used to be starter properties for young families. Now they're becoming long-term rentals. In certain metros, institutional buyers represent 10 to 20% of available inventory, effectively converting ownership stock into permanent rental stock. When investors can outbid local families with cash offers, prices drift further out of reach. Insurance markets are amplifying the imbalance. In states like Florida and California, major carriers are pulling back or exiting entirely due to climate risk and rising replacement costs. When insurance premiums double or triple, affordability collapses, yet oddly, prices don't. Instead, a different type of buyer steps in. Wealthier households who can cover high premiums or pay cash. Local families who depend on financing get priced out, leaving a narrower buyer pool that supports higher prices even as affordability crumbles. Taken together, These internal forces create a market that doesn't behave the way traditional economics textbooks say it should. Demand can fall, yet prices remain elevated. Inventory can appear stable, yet few homes are actually accessible. The mechanisms that once balanced local housing markets, mobility, flexible supply, reasonable financing, have weakened or reversed entirely. If these internal pressures continue, the U.S. housing market could drift into a new equilibrium where high prices persist regardless of economic cycles. And if that sounds like the upper limit, it isn't, because Level 3 reveals the ceiling America hasn't hit yet, and how much higher affordability ratios could climb if these trends continue. Level 3, the ceiling. America hasn't hit. When housing outpaces income by 3 to 4 times. If Level 2 explains the internal pressures pushing American housing upward, Level 3 shows something far more unsettling. The U.S. has not reached its affordability ceiling. In fact, by global comparison, and even by its own historical standards, America may still have room for home prices to climb dramatically relative to income. The reason isn't that wages are soaring or construction is booming. It's that the structural dynamics shaping the U.S. housing market increasingly resemble those of countries where affordability ratios are 2 to 3 times higher. Let's start with the benchmark. In the United States today, the national price-to-income ratio hovers around 5 times median household income. But in nations with similar economic structures and similar household expectations, places like Canada, Australia, and the United Kingdom ratios between 8 and 10 times income are considered normal. Their major metros regularly hit double-digit multiples even for modest homes. And while this video is focused on America, the comparison matters for one reason. These countries demonstrate that housing markets can remain stable and extremely expensive for long periods, even at ratios that Americans currently consider unimaginable. The real question is whether the U.S. could drift toward those affordability levels. And the uncomfortable answer is yes, because many of the pressures that push those countries into extreme price territory are now emerging in America, often in accelerated form. For example, job concentration in tech finance, logistics, and biotech mirrors the centralization seen in Sydney, Toronto, Vancouver, and London over the past 2 decades. As opportunity compresses into fewer metros, the value of housing in those metros disconnects from local incomes and begins tracking national or even international demand. We already see this dynamic in New York, Los Angeles, and the Bay Area, where affordability ratios have quietly crept into the 10 to 12 times range. These cities are not outliers. They are early signals, because when housing begins reflecting competitive bidding among high-income earners, remote workers, institutional investors, and global capital all chasing limited supply, local wage earners lose their ability to shape prices. That's how Boston, Miami, San Diego, and Denver joined the ranks of metros, where middle-class buyers now struggle to qualify for starter homes. These cities didn't become expensive in the traditional sense. They became structurally unbalanced. High-earning newcomers bidding against constrained supply can lift prices far beyond what median local incomes can support. And once that imbalance takes hold, it rarely reverses. For decades, families priced out of major metros could relocate to affordable secondary markets: Charlotte, Nashville, Phoenix, Dallas, Tampa. But as migration accelerated during the pandemic, those cities absorbed enormous inflows of demand, pushing prices up at some of the fastest rates in the country. Many once affordable metros have now moved into the unaffordable range, leaving fewer alternatives for young buyers. When escape valves close, national price pressure intensifies. Supply elasticity is another warning sign. Economists often assume that when prices rise, builders respond. But U.S. construction capacity is constrained by zoning restrictions, limited land availability, undesirable metros' labor shortages, and high material costs. Even in the best scenarios, construction responds slowly. And when demand spikes faster than supply can adjust, even temporarily, prices jump dramatically. This mismatch is how affordability can deteriorate with surprising speed. Could America actually reach price-to-income ratios of 8, 9, or even 10 times nationwide? Not overnight. But the mechanisms that held prices in check for much of the 20th century, cheap land, widespread job distribution, generous zoning, high mobility, have weakened. The guardrails are gone. What remains is a market where price growth is driven not by strong fundamental affordability, but by structural scarcity. And that sets the stage for something even more important: the social transformation that happens when a nation approaches its affordability limits. Because Level 4 reveals the turning point, the moment when American households begin restructuring themselves to survive a market they can no longer control. Level 4, the turning point, when U.S. households reshape themselves to survive. By the time a housing market reaches its structural limits, prices are no longer the story. Behavior is. And today, the United States is entering a moment where American households are beginning to change in ways we have not seen in more than a century. This shift is subtle, but it signals that affordability pressures are no longer temporary. They are reshaping the social foundations of how Americans live, save, and plan their futures. The first warning sign is household size. For more than 160 years, the number of people living in the average American household moved in only one direction: downward. Smaller families, more independence, more personal space. These were defining traits of the American lifestyle. But recently that trend reversed. Not because birth rates are surging, but because more adults, especially younger ones, are moving back into multi-generational homes. The share of 18 to 34-year-olds living with parents has climbed to its highest level since records began. Some return by choice, but most return by necessity. This shift isn't about cultural preference. It's about survival in a market where renting alone drains most of a young worker's paycheck, and buying a home requires a down payment that can exceed a full year's salary. Multi-generational living acts as a pressure valve, redistributing costs across families so younger generations can save. The pattern mirrors early-stage affordability stress seen in other countries, but in the U.S., it represents a historic break from long-standing individualistic housing norms. Another sign of structural strain is the lengthening of mortgages. Once considered fringe products, 40-year terms and 1% down loans are becoming more common. These tools stretch payments further into the future, giving buyers access to homes they otherwise couldn't qualify for. But the trade-off is enormous. Interest costs, balloon equity builds more slowly, and financial risk shifts from the lender to the borrower. Essentially, Americans are agreeing to pay more over more years simply to get a foot in the door. What's even more revealing is the return of creative financing, a phrase that once gained notoriety in the lead-up to the 2008 crisis. Today's versions aren't as reckless, but they represent a market straining to maintain transaction volume. Temporary buydowns, adjustable-rate mortgages, and lender incentives patch over affordability gaps rather than solve them. These products don't reduce home prices, they mask them. Housing preferences are shifting as well. For the first time in 50 years, the average size of new U.S. homes is shrinking. Buyers who once demanded extra bedrooms, bonus rooms, and expansive square footage are downsizing their expectations. Smaller footprints make homes slightly more attainable, but they also reflect a new reality. The American dream is being resized not by choice but by cost. Then there's geographic fragmentation. Instead of one national housing market, the U.S. is splitting into two Americas. In one America, places with fast-growing industries maintain relentless price pressure markets like Miami, Denver, Austin, Raleigh, and Boston. In the other aging regions with stagnant job growth experience, slow demand even as national prices rise. The gap between these two trajectories widens each year. Young professionals chase opportunity into metros, where affordability is collapsing, while lower growth regions fail to attract new residents. The result is a system where people must choose between earning enough to live and affording the place where they work. This divergence reinforces the structural affordability ceiling. When more people cluster into fewer opportunity hubs, supply becomes even tighter. And when fewer affordable alternatives exist, national prices remain elevated even in downturns. The U.S. housing market begins functioning less like a flexible national system and more like a patchwork of mini-markets, each with its own pressures, risks, and breaking points. These behavioral shifts, multi-generational living, extended mortgage terms, shrinking home sizes, and regionally concentrated demand are not symptoms of a temporary shock. They are the foundation of a new equilibrium, one where affordability doesn't rebound after a cycle, it resets permanently to a higher baseline. And that leaves us with one final question. If these transformations are already underway, what does the next decade of American housing look like? The four levels we've explored all point to one reality. The U.S. housing market is not drifting towards stability. It's redefining what normal looks like. Affordability isn't improving with time, and it isn't waiting for rates to fall. Instead, the market is reshaping how Americans live, move, and plan for the future. Multi-generational households, shrinking home sizes, and long mortgage terms are no longer exceptions. They're becoming structural features of a deeper housing affordability crisis. But understanding these levels gives buyers and policymakers a clearer sense of where pressure is building and where opportunities may still emerge as the U.S. housing market continues to evolve. Which level surprised you the most? If this breakdown opened your eyes, hit subscribe so you never walk blind into the next shift in America's housing future. Tie-ins. They're becoming structural features of a deeper housing affordability crisis. But understanding these levels gives buyers and policymakers a clearer sense of where pressure is building and where opportunities may still emerge as the U.S. housing market continues to evolve. Which level surprised you the most? If this breakdown opened your eyes, hit subscribe so you never walk blind into the next shift in America's housing future.